session today. We're going to be having a business leader dialogue session today, where we'll be talking about the role of partnerships in digital financial services. I'm going to share my screen and then we'll get going. So this work is actually born out of research we did in the Sustainable and Inclusive Digital Financial Services Initiative in Lagos Business School. Please, can you confirm that you can see my screen?
Yes,
We can.
Okay, excellent. So at the end of this session, we hope to help you see the role of partnerships and collaborations in the space. We would like to show you how collaborations are consummated, considerations in getting into collaborations. Please, can we go on mute if we're not speaking? That way it reduces the background noise and makes it easy for us to follow. And then also the common challenges with collaborations. We're also going to create an open platform to discuss the different types of collaborations that exist in the DFS space. We will understand the common challenges with collaborations and learn from each of them. We would brainstorm and identify some common solutions. We would understand how to use a toolkit we've developed in SIDFS in designing and delivering partnerships in this space. And we're going to make all these materials available to you right after the session. So what are collaborations and partnerships? Any cooperative effort between two or more independent organizations to develop, manufacture, or sell products or services. Now, ladies and gentlemen, you will agree with me that digital financial services, which is the space in which we all play, involve structurally complex transactions, products that involve not just a financial service provider, but a financial service provider, an agent, sometimes a mobile money operator, a fintech, an aggregator, a payment services provider. So what you technically realize is that to deliver and effectively deploy financial services using digital means, you actually need a web of partnerships involving multiple players at various levels, playing different roles, and all working towards ensuring that the product is defined, delivered, and consumed. Now, what are some of the motivations why firms actually go into partnerships? Firms go into partnerships for various reasons. Sorry, can Jane go in on mute, please? Thank you. Yeah, thank you, Jane. So why do firms actually go into partnerships? So firstly, firms go into partnerships to enable focus. So you want to be a mobile network operator, you want to be a mobile money operator, you want to be a financial service provider. So you want to focus on your core mandate. And you actually want to leave out those things you don't consider core. And you want to depend on those organizations who consider those other activities as their core to deliver that complementing service to you, to enable you deliver your value proposition to your customer. Now, that's number one. Secondly, to reduce costs. So firms actually go into partnerships to reduce costs, make it easier for their products to get accessible, outsource aspects of the product or service to firms that have larger scale and better capabilities to manage costs. Firms go into partnerships to access new markets. So you're in Lagos, you want to go into Abuja, you want to go into Kaduna, or you want to move to Ghana or Sierra Leone or Kenya. You identify a partner who has market knowledge and is able to actually make the product available in those markets. Firms also go into partnerships to assess new customers. Sometimes you actually have a core
So when you
customer
say
group.
pitches, what exactly do you mean?
Sorry, please, can the host and co-host be put everybody on mute, please?
Mm-hmm.
Thank you. So people actually want to gain new customers or enter new businesses, new product areas, new product categories, or new service areas. People actually get into partnerships to complete a solution. So you're a digital financial service provider and you want to offer a financial service product that has a complementing insurance leg or a complementing travel leg or a complementing educational leg. You get into a partnership with a provider who is licensed and authorized to offer that service. And then that partnership helps you offer the customers a solution that is a lot more complete. Now, people also partner for innovation and differentiation. So you want to get into new service areas, you want to serve your customers in new ways, or you want to offer a compelling value proposition that enhances your appeal. You actually get into a partnership. People partner to enhance new revenue sources. So you have existing revenue streams that come from your existing products. You want to get into new service areas. You want to extend existing offerings into new segments, or you want to deepen your play or your presence in existing segments. You get into partnerships. People partner to access new resources. So you have typical conventional resources you have access to, and then you have those resources you don't have access to. So you get into a partnership that makes it possible for you to access those resources. People get into partnerships to introduce new products. So you have conventional products, and then you need new products that make it possible for you to serve your existing or new customers you're trying to bring on the board. You get into partnerships. People partner to overcome trade barriers. So you have trade barriers, you have laws, you have regulations that prevent you from either going into specific areas or going into new segments or offering new products. You get into a partnership that enables you to overcome that barrier. People partner to avoid or overcome predatory competition. So you have a dominant competitor who has a play, a scope and span that makes it very compelling for them to actually operate. It becomes easy for people to partner with them. Now, people also partner to pool resources, skills, and risk capital. People partner to share risk. And then last but not least, people partner to share R&D expenses. So you have sectors or industries that require significant investments. So you get into a partnership to ensure that those R&D expenses are evenly shared across the board. Now, in working with organizations over the last 10 years, especially in thinking about partnerships and in designing or consummating the kinds of partnerships they have, there are essentially three core types of partners organizations typically have. Number one are the supply partners. So, I mean, this is very conventional and very typical. You are a financial service provider, you get into partnership with an organization that supplies POS machines or ATM machines or cybersecurity solutions or checkbooks. So you get into a supply partnership where a contract or a purchase order is issued where the partner supplies a particular resource, product, or service that enables you to complete your solution. So a supply partner can also help you achieve faster time to market, helps you focus on core competencies, give you competitive advantage, or helps you reduce cost. Now, you also have distribution partners. So these are partners that help you ensure that your product gets to the last mile. So in our space, distribution partners are typically agents, super agents, etc. So distribution partners help you extend sales reach, accelerate sales, reduce cost. Now you also have influence partners. What do influence partners do? Influence partners help you provide brand leverage, extend market reach, and help you deliver cost sharing. So they don't help you distribute, they don't do any supply, but they just provide brand leverage. They help you look better, they help you share costs of increasing awareness and increasing top of mind. Now, in partnership, there's also this concept of the whole product. Now, the whole product is like the minimum set of products or services we actually need to fulfill a target customer's compelling reason to buy. Now, what's the concept of the whole product? The concept of the whole product is that in some instances, we as financial service producers have core products. So if you look at the diagram I have here, I'm actually using the PC, where you have complementary products, hardware, software, peripherals, connectivity. And then you have the complementary services, which include the post-sales, the pre-sales, the legacy interface, and then even consulting. Now, you also have sales and distribution partners who essentially look at how you actually deliver the product. So when you look at selling, depending on the complexity of the solution you're selling, as well as the complexity of the marketing or selling process, you might actually have high touch or low touch distribution partners. So in thinking about this, so think about someone who is selling mobile phones. Now, mobile phones are relatively complex, but they are not very structurally complex or sophisticated. So in this case, you can actually have a sales and distribution partner who is significantly low touch. I mean, it's easy to identify merchandisers or throw in merchandisers that can actually provide information on what the technical specs of the phones are, etc. But then think about selling things like enterprise resource planning systems, where you actually have very complex solutions and you need to have high expertise in selling. So in this case, you're going to need a high touch type of partner. Now, influence partners also have multiple categories. So you have marketing partners that help you essentially have brand association. And what do they deliver with their brand association? They help you generate and strengthen demand. You have side-by-side selling partners. There's really no fantastic relationship. Both of you just stay on the sidelines in the market, and both of you sell side by side because there are some complementing features and benefits that enable your products rub off on each other. And the core value in side-by-side selling partners are account relationships. Now you also have association partners. Association partners help you have group affiliation. So here you have Association of Mobile Money Operators, Association of, or rather, Committee of Bankers, etc. So these are partners that actually come together, think about the common problems they have, and then lobby together, negotiate together, and get benefits for the entire group. So you have ecosystem partners that help you have network effects. You have government partners that help, for instance, in investment facilitation, trade facilitation, negotiation with foreign governments, etc. So these guys offer the value of business endorsement. Now, also, when you also think about partnerships, it's also important you think and ask yourself, what exactly is my motive, or what benefit do I actually want to get from this partner? Do I want a partner that would help me earn more revenues, or do I want a partner that would help me build out and develop my core competencies? Now, that partner who has a high potential to help you build your core competencies, as well as a high potential to enable you earn revenues, is what we call the strategic partner. And the strategic partner is that partner you want to pay a lot of attention on, spend time cultivating the relationship, engage a lot more and better understand. Now, you also have the earning partner, that partner who helps you earn a lot of money, but provides little benefit when it comes to building your core competencies. You also have the learning partner, that partner who helps you build your core competencies a lot, helps you better understand customer needs, customer trends, etc., market needs, helps you enhance and build out your processes, but has very little earning potential. That's a learning partner. Now you have the limited partner. Now, the limited partner is that partner that has little potential to grow your core competencies and little potential to improve your revenues. So that's the kind of partner you actually don't want to spend too much time on, and you want to limit your efforts in that kind of partnership. Now, also, it's important as you think about partnerships to ask yourself, is my relationship with this existing or potential partner going to help that partner as well as myself offer and deliver a mainstream product? Or am I going to be offering an adjacent or contiguous product? Or am I going to offer a product whose potential worthiness is low, revenue productivity is low? Am I going to be offering an orphan product? Or am I going to be offering an unworthy product? So it's important you understand, because what this helps you do is it helps you understand how strategically significant and important you are to this partner, and to what extent they're going to invest efforts and resources in building out these partnerships. Now, in creating partnerships and consummating partnerships, there are actually three essential forms of value misappropriation, which I'm going to speak about here. And it's important you realize this, because these are the things that create problems when, especially firms that have lower levels of sophistication, as well as process and maturity, go into partnerships. Now, the first is adverse selection. What adverse selection speaks to is essentially misrepresenting the value of inputs. Because you are the provider of the inputs, you better understand the inputs, and it's easy for you to actually claim that the inputs are going to be delivering a lot more value than they will in real life. Now you have moral hazard. Moral hazard is providing inputs of lesser value than promised. And then you have hold up, where essentially you're trying to exploit transaction-specific investment of partners to make unusual demands once the relationship has kicked off, because you realize that your partner has made those investments.
What the challenges of people?
Sorry, Idris. Oh my goodness, yeah. Oh, okay. Now, what happens in moral hazards? Consumers take greater risk knowing that the cost is borne by a third party. What happens in adverse selection? Buyers or sellers have a lot more information on the product than the other. So let's look at adverse selection. Adverse selection is essentially a situation where sellers have more information than buyers. And because sellers have more information than buyers, they're able to negotiate unfair terms, unfair deals, because the buyer doesn't know as much about the product as the seller. And what essentially the seller is exploiting is asymmetric information. The seller has more information than the buyer. And what asymmetric information is also called is information failure, because one party who better understands the product, has more experience in the sector, has more transaction-specific knowledge than the other party. And typically, they are more knowledgeable than the seller. Now, symmetric information is when both parties have equal knowledge and are able to equally negotiate. Moral hazard is a situation where one party engages in a risky behavior or fails to act in good faith because it knows the other party bears economic consequences of the behavior. Right? And anytime two parties come into an agreement with one another, a moral hazard can actually occur. So a very good example of a moral hazard is car insurance. Now, when a driver is in possession of car insurance, they may exercise less care when operating their vehicle than an individual with no car insurance. The driver with a car insurance policy knows that the insurance company will pay the majority of the resulting economic loss if they have an incident. Checking. Checking is a relatively active approach, and this happens a lot in partnerships. You get into a relationship and you avoid contractual duties. You focus on the short-term benefits and you impose as much possible as costs on the relationship, the partnership, or the joint venture. So a very good example of this is when you have multiple friends who go around bars drinking. And then you have those guys who, or ladies who ensure they keep going round and avoiding bearing the responsibility of payment. Now, you also have free riding. So free riding is a lot more passive, where, you know, it's more like sitting on the fence and waiting for others to make arrangements, and then you actually benefit from the arrangements. Now, this can very easily be done if your contributions are small, and if the value of the relationship is more to some other person than you. And the best moment to actually avoid free riding is during the negotiation phase. And you can achieve this by better defining each party's obligations, or by making sure that the collaboration has comparable importance for all partners. So as much as possible, free riders should be removed. Now, hold up is actually the most strategic approach. And what hold up essentially does is it exploits the partner's dependency on the alliance. So think about it. A plumber comes to your house, dislodges your um, toilet system, and then tells you you need to pay X amount of naira before he continues work and buy X amount of material. So that's a hold up situation. If you don't pay that, your water system, your plumbing system gets down. So what partners essentially do is they try to use this approach. They try to avoid this in the contractual phase by making sure they don't leave things too open. Yeah, Abdulaziz, can you go on mute, please? All right. So essentially, bigger firms have a tendency to do this with smaller firms. And one of the ways you can actually avoid holdup is getting a good advice, or getting good lawyers that actually, you know, sort of advise you and make sure you don't get into these structures. So what are some of the benefits of partners? Partners help you achieve economies of scale. They help you learn from competitors. They help you manage risk, share costs. You know, essentially where costs are large, especially costs of distribution, costs of awareness creation, costs of R&D, a partner can actually help you share this cost and reduce the risk. A partner can also facilitate tacit collusion, where both of sort of come together, create a block, and create an oligopoly. Of course, that's subject to antitrust regulations in the climate or context, as well as the industry. A partner can help you achieve low-cost entry into new markets, new segments, because you don't have to go all out and incur all the costs in setting up the facilities, buying the technology, or building the capability that will enable you get into a new market. Partners can also help you achieve low-cost entry into new industries or new industry segments. Last but not the least, partners can help you manage uncertainty. Now, there are a couple of synergies that can actually motivate partnerships that we can consider. Now, what are other ways collaborations can add value? They can help you improve current operations, change the competitive environment, ease entry and exit into a market, help you achieve economies of scale, you know, give you the opportunity to learn, help you in risk sharing, help you have access to supplementary services, increase brand awareness, help you assess a new customer base, and share risk. Now, when you want to enter into a collaboration, there are a couple of things you want to pay attention to. So first of all, understand who you are, understand who your customers are. Ask, do I really need a partner? For how long or why? How big is the payoff? How likely is the success? And what's the best form of partnering? Do I go into an alliance, which is free flowing? Do I go into a joint venture where I actually create a special purpose vehicle? Or do I just leave a freewheeling loose partnership? Now, who do I choose to go along this journey with? Does this individual, does this organization share my core values? Do they have the necessary skills and resources? Are they going to deploy these resources to the partnership? Are we going to have compatibility in culture? What's going to be the structure of the collaboration? What's the scope of the activity? You know, to what extent are we going to be strategically free to carry out the traditional activities for which we've been set up? What are the duties, payoffs, and responsibilities of each partner? You know, how do we ensure we have a win-win situation? What's the managerial role of each collaborator? And then in doing the deal, how much paperwork should we have? How much trust? What are the legal considerations? And then what's the end game? So in trying to make partnerships or collaborations work, try to give it top management support. Now, think very critically about cultural differences. Organizations are also uh, 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 beings that have personalities, that have cultures, that have ways of operating. Ask yourself, am I going to be culturally compatible with this partner? Watch out for inequity. So try to make sure that I put everything on the table. Don't try to play games. Remain flexible. And then ask yourself constantly, what value am I getting from this collaboration? So are there ways I can actually manage it differently depending on where I am on or in my life cycle? And if so, how exactly do I gauge where I am in the life cycle of the collaboration? What kind of key actions should I take? And then in building out a collaboration, you want to first of all set out a strategy for collaborating. Who are the kinds of partners I need? Why do I need them? What's going to be my criteria for selecting one? How do I structure it? How do I manage it? How do I evaluate it? So essentially, you're going to go from initiation, formation, growth, maturity, and then exit or shutdown. Now, there are multiple challenges in managing partnerships. First is integrity. So, what exactly does everybody bring to the table? So, most times, competencies, resources, and assets are misrepresented by parties. Also, collaborations may fail. Collaborators may fail to commit resources and capabilities as promised. One collaborator may commit heavily to the alliance while the other does not. Collaborators may also fail to use their complementary resources effectively. Lack of trust and experiences, in my experience, the biggest problem with collaborations. Incomplete lead or lag measures for success. So you must have the right KPIs and you must have the right framework for managing the performance of the partnerships. Culture clash. Executives may see the alliance as an extension of their main business. So think about cultures and try to ensure that all the partners understand that there's a difference between the partnership and their core business, so that they don't essentially feel because they are bigger players or bigger operators that the other organization has lost its independence. So there are a couple of case studies I would just like to share with you. The first is Equity Bank. So Equity reached 7.1 million customers through its network of 165 branches in 2006. They expanded their ATMs. And one of the anchors of Equity Bank's strategy was to grow out their digital footprint. Now, however, in 2007, banking regulations did not allow banks to operate through third parties. In contrast, informal permission was given to a mobile network operator in Kenya at that time, Safaricom. So a fantastic relationship created the M-Pesa agent network, and the success story has been fantastic. Now, in 2010, Equity entered into partnerships with 3 other mobile operators in Kenya to assess a mobile financial services channel that Equity could not create on its own. Now, Equity also created an Equitel a channel through which they could actually offer and deliver mobile financial services by partnering with mobile network operators. They partnered with Safaricom, created M-Kesha. Now, the story of digital financial services in East Africa is, to say the least, a fantastic success story. Now, MTN Ghana. MTN Mobile Money also launched in Ghana in July 2009 as a partnership between MTN and 9 commercial banks. Now, the service is exclusively branded under the MTN banner with no real visibility for the partner banks. MTN aspired to have first mover status in response to pressures from the mobile communication sector, while banks had not shown an interest in pursuing mass market customers. The Bank of Ghana issued regulations that permitted only financial institutions to launch mobile financial services, holding them responsible for the agent network management. And then mobile network operators were prohibited from playing a lead role. MTN, first of all, had discussions with a single bank that at least partly shared their interest. However, an amendment to the regulations was issued mandating a minimum of 3 branches. Now, this regulation ultimately opened up, made it possible for MTN to have multiple relationships, and this eventually extended into several other benefits. Now, I'm going to now move you into a session where we would briefly talk about our toolkit. But before I go into displaying the toolkit, I don't know, do we have any questions, comments? Ladies and gentlemen, any questions, comments?
Yes, I have a question.
Please go ahead.
Yes, I know you tried in the last few slides to look at what Equity Bank has done in Kenya in terms of maybe their partnership with maybe the mobile money operators, and even what they've been able to do on their own to strategically maybe improve what they are doing. Is there an alignment or maybe a correlation of what they've been able to do in Kenya that you can maybe point out in our own economy here? And that's one. In one of the other sections that we heard, I think the last one where we had somebody from one of the maybe PSBs I've forgotten the name of the Indian man, PSBs in India.
Fino Payment Service Bank.
So, yes, he told us that one of the key things you should determine when you are going into a partnership, especially for financial institutions, is who owns the customer. You should be able to say who owns this customer, so that at the end of the day, when you enter into that partnership, you don't go into issues as per the owners of the customer when value starts coming out. I don't think you mentioned anything like that here. And how are we that even in our own? I want you to localize these two scenarios I've painted, if you are able to, sir. Thank you.
Okay. Thank you very much, Larry. Now, in asking and answering the question, who owns the customer? It's a bit of a tricky question to ask and answer, and I'll tell you why. Depending on the nature of the product or service you're offering, or depending on how the partnership is supposed to help your business, it may be difficult to categorically say this person owns the customer or this person doesn't own the customer. Now, remember, we're not talking about partnerships essentially for distributing mobile financial services. We're talking about partnerships in general for you all as operators in the digital financial services ecosystem. So some partnerships do not involve owning, distributing, or not owning customers. I don't know if you understand me.
Yes, I do. I'm getting it.
So some partnerships do not mean owning customers. Now, in some other partnerships, what could actually be happening is that both firms may be coming together to create an offering that will appeal to the customers or the traditional customers that both institutions have, such that as they create the joint value, that joint value becomes more attractive to either of the customers and causes either customer on either of the sides to buy more or even consume more. So it's not in all cases that it's clear cut to actually say this is who owns the customer or this is the value I'm bringing. The value I'm bringing is scale. But then, yes, in a lot of instances, especially when fintechs try to partner with conventional deposit money banks, the whole idea is that fintechs are actually creating solutions and are hoping to sell those solutions into existing customer bases that the deposit money banks have. So in that instance, yes, you can actually say to some extent that the deposit money bank owns the customer. So that's on the one side. But ultimately, the principle or the mindset of partnering is that you both are actually coming together in line with the goals and aspirations that you have set, either for that initiative or for your institution. And you're coming together to create value that either of you, or I mean, in the case where you are 3, 4, or 5, where any single one of you could not create that value alone. And you recognize that that other member of the partnership has value they bring. And you negotiate how the value you bring is going to generate more value, and how that additional value created will be distributed or appropriated. So it's very important you keep this in mind, because the problem a lot of us have in partnerships is that we enter into partnerships with selfishness in mind. Me alone. How do I outplay or outsmart these guys? How do I get my lawyers to prepare NDAs that give me all the protections and offload all the risks and liabilities on my partners? How do I ensure that I get the highest commission from whatever sale we make? That's essentially not the mindset of building enduring long-term partnerships that create value in the long term. If you actually want to create that type of long-term partnership, you also have to open up your mind and think win-win. Right? Lanre, is that helpful?
Yes, I'm good. What of the first one?
Good. Now, the first question you asked is, how does the Kenyan situation play out in Nigeria? Right? So in the case of Kenya, or rather in the case of East Africa, in general, because the same thing that happened in Kenya happened pretty much in Tanzania, Uganda, South Sudan, and then even Rwanda. So in the case of East Africa versus Nigeria, West Africa, as the case may be, in their own case, their digital financial service, agent banking, mobile money revolution had a head start. And one of the things that helped them have a head start was that a mobile network operator that was state-owned took the lead without necessarily having, any reliefs, benefits, or regulations or laws, as the case may be. And then in these other climes, you have financial service institutions that are stronger and have better negotiating power, who refused that the mobile network operators would not come into their space and take the lead. However, that has changed today. So we now have payment service banks, and it's public knowledge that all the major mobile network operators in Nigeria have either received final approvals or approvals in principle to run payment service banks. So they are currently refining their strategy. They are currently rolling out investments. They're currently building out their networks. And very soon we're going to see a lot more traction and presence of them in the market. So that same East African play, we're most likely going to see it in Nigeria in the next couple of years. And what that tells me automatically is that the landscape of banking is going to change significantly in the next 5-10 years in Nigeria. The way we see banking today will certainly not be the way banking will be in the next 5 years. Banking will remain relevant and important. However, we are not sure of how important banks will be. So more ways of financially intermediating will evolve and emerge. However, will banks remain relevant? We don't know. Larry, I don't know. Was that helpful?
Very helpful. But the last statement you made again, you said, will bank remain relevant?
Yes.
I say you don't.
Banking. So banking will remain relevant. However, will banks remain relevant? So think about how banking has evolved. Banking 10 years ago used to be what you go to a branch to do, right? what you go into a banking hall to do, what you go sit down to negotiate with a relationship manager. Today, what is banking? Banking has become what you do on your mobile phone, on your platform, where you go on platforms, create the services, serve yourself, print your bank statements, make your payments, offer yourself the products and services. Do you understand me, Larry?
Yes, yes.
So banking has evolved. And what you'll see over time is the conventional brick and mortar structure, the bank branch, will become increasingly less and less relevant. I mean, think about it. January to June 2021, total transactions processed through all the agents on the SANEF network was over 13 trillion naira. So all of these POS kiosks you see across the country are doing serious business. They are not playing. Do you understand? So banking will change in the next 5-10 years. However, we are not sure of how relevant banks will be in that future that banking will have. Okay, so ladies and gentlemen, I don't know, any more questions?
But thank you. We have two hands up. We have Professor
sorry,
Ajayi and we have Jane.
Okay, yeah, Prof, please go ahead, sir.
Yes, sorry, I just wanted to probably speak a bit to the question that Larry asked, maybe to try to understand better where he's coming from. Because when he said who will own the customer, I think that will, of course, as you did mention, that depends on what typology or model of partnership is in view. But I think, of course, there is a wide continuum in as to what is a partnership, ranging from mere collaborations to farm hookups and mergers and so on and so forth. And I'm not too sure whether you have pitched your tent at one end or the other, whether it is still understood that the general idea is collaborating in order to create value, and then looking for what meets your strategic objectives. Looking for the collaborations that will meet your strategic objectives. I think the point as to who owns the customer is also a bit clumsy, because that would depend on the legal relationship between the providers and the customer. In other words, is there a sale? Is there a service, and who is providing the sale or the service? What type of contracts are in place? But that also speaks to the point that the legal side of things may also be useful in terms of, so as to clarify some of these expectations of the parties. You quite rightly made the point, though, that the legal side may be okay, but the commercial or customer focus and perception is really very important. Because even if you have an agent go and service a customer and he comes across as more agile, more helpful, the customer may very well bond, better with the agent and say, why don't I? And the agent may then say, well, why don't I launch activities? So I think the whole idea of, and I think Larry's point brings to fore that the customer should be at the heart of these collaborations. Correct. They should not be production-centered collaborations, yes, but ought to be customer-centered collaborations, because that's what will ensure not only that the products and services are, human-centered in terms of design, but that they will be sustainable and especially even competitively. So I think that's a very important point. I think finally, the issue you raised on bank and banking, it was just that it was tickling my mind that typically banks are licensed to take deposits and lend money. And that generally is a function that is legislative. So if you say we don't know whether banks will be relevant, then we will know whether central banks will also be relevant.
That's an absolutely important point, Prof.
That would be the end point. But I think as you did mention, the most important thing, of course, is for organizations to really look at their business model. And the truth of the fact that the trends in financial intermediation these days is moving it to other financial institutions, moving it to peer-to-peer, and various other types of hybrid relationships. And perhaps the point there would then be for the traditional banks to be agile rather fixed. Not that, and I'm not too sure we're going to do away with banks in the sense in which we know it anytime in the future, whether or not we're even using cryptocurrencies or, so, but what I think it points to is that it behoves the traditional banks, DMBs and so on, to actually find it very fluid to collaborate with these hybrids, OFIs and so on and so forth, which I think is really what we would have, that they may be doing more of the traditional functions, but there are intermediaries that they can use. Thank you very much.
Thank you so much, Prof. Very well spoken. Very, very well spoken. Okay, Jane, can we have Jane, please?
And then the last thing you said was that
Good afternoon, all.
Good afternoon, Jane. How are you
So
doing?
I just want to add my 2 cents to the discussion, particularly around the ownership of customers, which Larry had put forward. The truth of the matter, out there, really, it is a big deal. I've seen discussions being advanced, and it breaks down at who is the owner of this customer, by the way. Maybe like 10, 12 years ago, when the introduction of mobile money, that was a major reason why the banks and the telcos really couldn't collaborate well, because it was a case of who owns the customer anyway. The telco was like, oh, I have more of these subscribers, I'm the one bringing them in. And the bank will say, but they are coming to come and consume financial service, so they are my customers. Who owns the customer? Who owns the customer? Negotiation breaks down. Nobody is able to put ink the contract. It cannot program. But over the years, I mean, we advanced more so in the wake of digital transformation, which has come to affect and I mean financial. Notice that definitions and the models are actually beginning to fail. So the question to ask really, who is a customer? In many decades ago, you could tell who a customer is, but today, who is a customer? Is it because the person, and I liken it, whenever I'm asked this thing, I liken it to marriage. Who is the wife? Is it the one that has the marriage certificate, or the other one that is outside and calling the shots? Really, who is really the wife here? So and my advice would be, maybe a better term to use now is call them users. I think the customer thing is going to get downplayed, and at a time maybe it may even go away from the vocabulary. As an operator, just find how to provide value, and if we can stay away from this customer ownership discussion, it will do everybody a whole lot of good. Because the truth of the matter is, customers own themselves.
Correct.
Because
Correct.
digital products are so accessible today.
Correct.
These guys cannot stay. I mean, before you could tell if you had an account with, say, the then old maybe First Bank, maybe in the 70s, that was the only bank you probably knew. But today, you can start off a relationship with First Bank, and by night you have jumped over to Zenith.
Correct.
It depends on who's providing the value for you. So the reality is, the customers own themselves. You just must have to work hard to find out how you can provide. Just look at the value chain, find out how you can provide the most value so that you can keep this customer, whoever that person, whether it's a customer or user, attention for long.
Excellent point, Jane. Excellent point.
And today, really, in discussions, it's not even something we bother to address anymore.
Exactly.
When we're contacted, you don't bother
Exactly.
because we realize it's kind of outdated.
It
That
is.
is my
It is.
honest
It is.
contribution. Thank
And
you
the
very
truth,
much.
and the truth, like you've highlighted, Jane, is that these tough battles of who owns the turf, who owns the customer, I mean, who is trying to be cheated, whose network is trying to be assessed, also prevents us from truly assessing some of the benefits that these partnerships will bring. So I think it's important we get away from that mindset, just like you rightly said, and focus more on creating value. Thank you so much, Jane.
Absolutely. Absolutely.
Yeah, thank you so much. Musa, please go ahead.
Thank you very much. I echo most of the comments made. I just wanted to approach it from the trust side. I agree with you very strongly that trust, I think, is a foundational element of building partnerships. And I dare to say that you're right. It's the single biggest reason why partnerships have not blossomed as perhaps they should. And I think already the comment has been going in that direction. So I'll use it as an example, but I'm not trying to create any problems between industries. A very good example to me over the years has been this constant USSD versus banks situation.
All right.
And, the reality is that when you spoke of the Ghana and East Africa examples, what you had were situations where the banks and the telcos, as it were, needed to work together. Right. In this situation, there's almost a sense that I don't need you. And
it's an extremely dirty situation.
Yes. Yeah. So even when the regulators come together and then announce that they've resolved some issue, you as a person operating in the industry know that it's not going to really yield fruit because they are not the interested parties per se. They're interested in seeing a resolution, but they're not interested in the real outcome. Or rather, the real outcome in the market is still a function of the operators. Right. And the operators do not fundamentally trust one another. Right. And so, it goes back to everything that is done in spelling out that partnership, including the contracts that are drawn. Right. You've said it all, and it really exists in that way now. There are no mechanisms for reconciling differences well enough. What is written on paper is totally different from what is said in public.
Absolutely.
And so it does not engender that trust. And so as long as we continue playing this game, and as long as we continue to deal with those issues of who owns the customer and so on, or implying who owns the customer, we won't get far. We understand that, yes, there is a need for a customer, but over time, what happens more? We're all in businesses where transactions are what make us the money. It's who grows the transactions that we should be thinking about. Exactly. Who helps us grow that? And the transactions, of course, index back to the people. It means the people see value in what you are doing. Exactly. And how do we establish that? But for on and on and on, we are still dancing around the trust issue, and that's the fundamental problem right the way across board everywhere.
Absolutely.
So,
thank you so much. Thank you.
You're most welcome. You're most welcome.
Valid comment. Chiamela.
Okay, thank you, Doc. Thank you for quality presentation. I'm happy now. In fact, we realize that technology is needed in rendering a financial service, and that is DFS we are talking about. And most importantly, now we are beginning to see the partnership and the strategic alliances, which is actually what is needed instead of the competition we are having among ourselves. But the truth is, we are competing. We are rather not really partnering, or there's no strategy alliance by the way. But I actually want us to, I want to look, I've been looking at the direction I want us to also look at. So if you find out that even the alliance thing, the essence of it is just to deepen financial inclusion. But you still find out that this thing still centers around BVN. Then I'm beginning to ask, wouldn't we do more if we begin to rather look at the mobile telephony more than BVN? Because the truth is this: if you go to the bank to sign up a relationship with them, BVN will be required. You go to become a mobile a POS agent, BVN is needed. You want to apply for loan through an online mobile wallet, BVN is needed. So I'm asking, I'm rather thinking, can we begin to look at mobile telephony? That means the number of people who actually use telephone. Would that really help us to reduce exclusiveness, financial exclusiveness? And I think that would achieve more in that area. That's what I want to bring to the table.
Okay,
thank you.
Thank you so much, Chiamela. I mean, of course, the relevance, the value, and the role of BVNs would remain an ongoing debate, you know, even in the coming years. But one thing we also have to realize are that lots of these other markets that have better developed identity and access management systems have over time, over the years, invested in building out national identity databases and systems.
Okay.
So the unfortunate thing is that, you know, we are latecomers in this space.
Yeah.
And the very nature of how mobile numbers were acquired may not necessarily give us the comfort that proper due diligence has been done in verifying and establishing the identity of who actually owns which mobile phone or which mobile number.
Yeah.
So that is probably why we still have that significant reliance on the BVN, considering that the BVN is collected by a bank who is expected to have done some level of KYC on you. Now, it doesn't mean the BVN is 100% foolproof. But if you go to other developed markets, you don't get to hear of things like BVN. Rather, you get to hear of things like social security number.
Yes.
And that's a lot more universally accepted.
Yes.
So we are evolving, and you know, we're going through our own paths. It's not going to be entirely smooth. Now, the truth is that the regulators are also learning. If you think about today's payment service banks, 5 years ago, the regulator stance was we would have no single thing called banking offered telcos.
That's true.
But today, that has been relaxed.
Yeah.
They went to India, they got the template. In India, they are called payment banks. But when we got the template from India, we came to Nigeria and we called it payment service banks.
Yeah.
Now, in licensing these payment service banks, we've told them, okay, these are activities that are permissible, these are activities that are not permissible. These are the limits and the thresholds, just to ensure that we still create a band and scope that still allows conventional banks operate as we have been licensed to. So these things would, in my view, ultimately open up. So very soon we'll begin to have tier 1 lending, etc., happen at the PSB level. I also expect that we're going to begin to see things like foreign exchange transactions even happen at the PSB level. Now, when will it happen? I don't know. But will it happen? It's a very strong likelihood. So let's go through our own paths and, you know, let's evolve as we best understand it. Okay, ladies and gentlemen, I'll quickly move into the toolkit because we are far gone with time. Now, the whole essence of this toolkit is to guide you through the process of designing a partnership, aligning your goals and objectives, implementing a partnership, evaluating a partnership, and then looking a partnership in the face and saying, do you know what? I'm no longer interested in going ahead with this partnership. So what this toolkit aims to answer is, how do I go into a partnership? How do I identify the right partners? How do I align my strategy, my goals and objectives with that of my partner? How do I cultivate, build, and grow a trusting relationship with my partner? How do I identify common points of interest upon which the partnership can be based? What resources and capabilities would I deploy to the partnership? How am I going to operate this partnership? How am I going to identify and resolve conflicts that will arise in the course of business? How do I evaluate the performance of the partnership? And how do I exit the partnership? So what this toolkit does is it helps you manage the entire end-to-end life cycle of the partnership, from initiating the partnership, the documentations, implementing the partnerships, measuring the performance of the partnerships, scaling the partnerships, and then exiting if possible. Now, there are a couple of critical success factors that help you drive and deliver effective partnerships. Now, the first is mutual respect. So it's important that we respect the uniqueness and the independence of all the organizations in the partnerships. So it's important we recognize and we remain conscious of those motivations that make it possible for all the members to actually come into the partnership. What are their goals? What are their intentions? And what differences do they bring to the table? The second is goal congruence. Now, while we recognize and realize that multiple organizations have different goals, it's important that partners approach relationships in good faith and reconcile the goals. What are those points at which my goal and your goal as a partner, collide, reinforce each other? Can we build and base this partnership on this point of what? Goal congruence? How do we ensure we make this relationship remain mutually beneficial as we move along? Trust is very important. Trust facilitates information sharing, development of joint products, coming together to actually fight external threats. So in partnerships, it's important that we approach it in best faith and that we trust each other. Capability. So it's important that once we align our goals and objectives, that it is established that these are the capabilities I have that make me valuable to my partner. And these are the capabilities I seek from my partner that make it possible for me to continue in this partnership. So it's important we pay attention to this and we grow this over time. Clarity of roles and responsibilities. So you have to be clear to the lowest level of granularity. What is each partner's role? What is each partner's responsibility? And how do we ensure that we have a partnership or an alliance management framework that defines who is responsible, who is accountable, who will be consulted, and who will be informed? Gilbert's RACI matrix is always helpful in that. Now, conflicts of interest. Now, challenges of conflicts of interest arise a lot, especially when we're entering into partnerships with partners who offer the same or similar things as we offer. Lots of times the question is now, when issues where competing interests come to the table are discussed, on which side of the divide do we tilt? So it's important that these conflicts of interest are identified and addressed. It's important that we also look for those allies who have had prior experience with partnerships. Now, let's also always think win-win-win, positive sum competition. So let's think about how we create value for ourselves, and let's also ask, how do our partners create value or benefit from whatever value this partnership creates? So don't always think in a greedy way. How can I get all the value? Now, the truth is you can actually get all the value today, but that marks the end of the partnership. Now, have a robust evaluation process. How do I evaluate this partnership? How do I ensure that this partnership is constantly delivering the value I seek? How do I guarantee transparency and commitment? And then And then the next is to actually, first of all, go into a table I call gives and gets. Now, I find this table incredibly important because it helps me sort of ask and answer, what can my partners give and what can my partners get? So is it technology? Is it resources? Is it relationships? Is it reputation? Is it core competencies? Is it chemistry of key people? Is it company vision? What can I give? What can I get? So completing this table is always very important in sort of asking and helping me understand what I'm actually looking for in this partner and how best do I create a structure that enables me derive best value from this partner. Because sometimes some of these things are imagined, some of these things are expected, but because we don't commit them in writing and put them on paper, it becomes difficult for us to build strategies that enable us to extract the value from them. Now, the next is relationship overview. And then in the relationship overview, what you try to define here is what's the nature of the relationship. So is this a supplier relationship? Is it a distribution relationship? Is this an influence relationship? What's the history? What's the level? So does this relationship exist at the CEO level? Does this exist at the level of the purchasing manager? What's the importance of this relationship to me? Is this strategic? Is this opportunistic? Is this tactical? How long do I actually expect this relationship to last? Is it 1 year, 2 years? Is it 3 years? Is it 5 years? Now, opportunity overview. Now, what I essentially use this table to do is to map out what kind of problem is this partnership trying to solve? What's the size of the problem? What are the dimensions? What are the ramifications of the problem or the opportunity? And what are the compelling motivators? And here, I typically try to start out with a problem statement. What am I trying to address? Am I trying to address a business issue or a technical issue? What's the size of this opportunity? So can I measure this opportunity in terms of number of customers, in terms of revenues, in terms of number of processes, in terms of productivity enhancements? What are the ramifications? So what are the consequences if I don't address this problem? What are the compelling motivators? What are those reasons that force me to act? Now, the next is business overview. And what business overview helps me do is it helps me make a business case for partnership. What's the market offer? What are the goals? And then what's the proposition? So what's the combined offer to the market? If I were to go alone, what would I offer? If I were to go with my partner, what would I offer? What are the goals of this combined partnership in terms of revenues, market share, reach, profits? What's the combined business proposition? So what value does this bring to the partner or to my company? And then what are the gives and gets? Now, what's the success overview? So it's good to use this table to actually define what success would look like. So what will work to the partnership's favor? What are the blockers? And how am I going to measure success? Both from me and from the point of view of my partner. Now, in executing the partnership, this table I actually use to now execute. The tables I described earlier, I used to do what? To create, to conceptualize. Now, in executing, I ask, what are my goals? Is this the best approach to actually attaining my goals? Or should I even go into a partnership? Maybe I shouldn't go into a partnership. Maybe I should make the investment, or maybe I should build the capability in-house. Can I achieve these goals through an existing partner, or should I look for a new partner? What benefits are they likely to bring to my organization? What resources and capabilities do I lack that I hope to acquire through the partnership? What resources and capabilities will I deploy? And which of the above indicated critical success factors does this partnership need in order to be successful? Is there a genuine shared vision? Do I have goals that tie me and my partner together? Now, from a due diligence standpoint, who is the potential partner organization? What's their history? What are their key products and services? What's their strategy? What resources and capabilities do they have? And which ones are they willing to deploy to this partnership? What kinds of staff do they have? What reputational risks might they present? And what vulnerabilities will this partnership expose my organization to? Now, from a communication standpoint, how are we going to communicate in this alliance? Are we going to have weekly meetings, nightly meetings, monthly meetings, or quarterly meetings? During these meetings, what's going to be the agenda? Who is going to be the executive sponsor of the partnership? How do I ensure that this partnership continues to have top management visibility? You know, what's the individual's position? How will decisions be taken? What procedures through what procedures will decisions and actions be taken? So it's always important you understand the differences in organizations and respect these differences. Clearly indicate how each organization will measure success, and then align interests and objectives of the partnerships to each other. Define the roles, the responsibilities, and the expectations of each partner, and have relationship managers who are responsible for day-to-day management. Identify the right types of partners, champions in all of the partnering organizations, and then build the network up down. Make sure that this partnership does not end at the level of CEO to CEO. When two CEOs meet, nothing happens unless the people below get it going. So try to ensure you build wide-scale support across the entire organization for the partnership. Have a full assessment of skills and competencies required to support the partnership in all of the partnering organizations, and try to ensure that consideration is given to making resources for training available across the board. All partners should co-create and reconcile a detailed strategic plan for the alliance. So I always recommend that the initial stages of the partnership have a joint strategy retreat where all of the partners come together and agree. So what's going to be the structure? What's going to be the length of time of the partnership? How are we going to govern the partnership? How are we going to measure performance? How are we going to communicate? How will data be collected? And then ultimately define an end exit game for the partnership. Agree on trigger conditions for the exit. Put in place a detailed plan on the relationship, on how the relationship will be decoupled, realizing that systems and processes may have been intertwined over time, and recognize achievements and celebrate the alliance's main successes. So I will stop sharing again so that you can ask your questions. But like we said earlier, all of these materials we will share with everybody. Questions, comments? Jane, please go ahead.
Thank you very much, Doc. So please, do you have a statistics of the effectiveness of this toolkit? So what's the success rate of using this toolkit?
That's an interesting question. So when you say success rate, would you say how successful? So using this toolkit is one thing. Whether you use it 30, 40, 50, 60, 100% is another. Now, how you interpret the elements of the toolkit is yet another. So I may not be able to give you a direct one-to-one answer on the effectiveness of the toolkit.
Okay, so is this something we can get hereafter?
Oh, yes, yes. The toolkit is going to be made accessible right after.
No, I mean the effectiveness, how this
Oh, yes,
performs.
yes, over time. So this toolkit was recently built. We don't have data on its effectiveness yet.
Okay.
Yeah, we don't have.
Okay.
I mean, we can't
May
give you
I
any
suggest that be measured?
Yeah. That's absolutely
Okay.
part of the plan. That's part of the plan. And thanks for bringing that on the table again.
Thank you.
Thank you so much. Okay. So, ladies and gentlemen, any more questions, comments, suggestions? Okay, it appears we don't have more questions. Okay, so I'll hand back to my managing director now, Mr. Timothy Alu. Timothy?
Okay, thank you very much, Dr. Nkem, and thank you for my new title. I didn't know I was the MD.
You are.
So we'd like to say a very big thank you to all our participants in today's session. Like Dr. Nke mentioned, we'll make all the materials available via email. But if you have any further questions or you need clarifications, please feel free to contact us via email and we'll be happy to respond to your questions. So at this point, I'd like to say thank you once again and enjoy the rest of your day.
Thank you.
All right, thank you.